Hi, my name is Lana Ward, and I'm part of the distribution team at Pengana Capital. Today, I'm joined by Ed Prendergast, co-portfolio manager of the Pengana Emerging Companies Fund. Ed, the last couple of years have been a really challenging time for small companies in particular. We've faced rising interest rates and inflation, and you've no doubt done well in such a setting. How would you reflect on 2023?
Thanks, Lana. Yeah, the last year wasn't too bad for us, 11.6% in a market that was up about 8%. Large companies were up 12%, so the small caps have underperformed again. A lot of that was due to mining stocks being slightly worse than the industrials. Reminder, we don't play in the mining sector, but there were a few stocks that worked very well for us. So Seven Group, for example, which is exposed to non-residential construction, that was a big holding of ours. That was up over 80%. Car sales was up 55%. And then the majority of the other positive contributors were what we call relatively boring defensive earning streams, like Propel Funerals, for example, and Austbrokers, which were both up over 20%. And there were a couple of very small holdings in stocks like Gentrack and Chrysos, which were up over 150% each. And, the stocks we prefer not to have owned, we're in the business of making a few mistakes every year, hopefully not many. Things like Capital Health, we had a small position there and that got caught on with a lack of pricing power, some cost inflation. And we had some residual exposure to the consumer environment, which worked against us with IVE Group and Ardent Leisure, which were smaller investments, but they certainly underperformed.
And Ed, you mentioned some areas of the consumer spending sector are still a concern. If you had a crystal ball, what could investors expect this year? Are there any sectors you favour or want to avoid?
We're a stock pickers fund, and we're always on the lookout. Our primary focus is on looking at stocks that can grow in any economic environment. So, but there's always sectoral ideas which are good. We definitely at the moment favour the insurance brokers because it's a very defensive growth industry, and we still think there's room for upside in the insurance rates, which is good for the brokers. Financial services in general is a nice fragmented industry, so things like Hub and Netwealth and MA Financial fit in. They're growing within their own industry. Non-residential construction, with the huge amount of government spending yet to come through, we still think that's an opportunity. And we're also pretty wary on the flip side of stocks in the retail or consumer environment because we still think that there is, notwithstanding the fact that the economy has sort of certainly not hit recession due to the higher interest rates, there's still a bit of risk around consumer spending and inflation. There's certain industries that do not have the pricing power that you need when wages start to tick up, and we think that's still, while inflation's not as bad as it was, we still think there's risk around that. And then if you look at individual stocks, really, no matter what we think of sectors, we're always looking for the best stocks within that sector or within even in industries that have challenges. But if we think about the insurance brokers, so Austbrokers and Steadfast and PSI Group are certainly well positioned. Propel Funerals fits very well into our portfolio and has done for quite a while. It's a very defensive industry by way of the volumes are always reasonably predictable, and equally the industry structure is very stable and conducive to further consolidation. Aussie Broadband's another business that it's a diversified telco, and that is people tend to trim spending in other areas other than telco, so people will always pay their phone bills if they're in business and they're across the corporate and consumer environment. And the other one I would point out is a stock that we've held for a long time, very well managed, Lifestyle Communities, which is growing in the retirement village sector, in the affordable retirement village sector in Victoria, and their customer base is typically at the lower socioeconomic end, and therefore they're less exposed to wild swings in consumer activity.
And everybody's got a different opinion on how the inflation story will play out. What do you think?
Well, that's certainly been the biggest driver of markets over the last 2 years, the extent to which people have got their forecasts on inflation wrong and interest rates. And so we've seen huge, very wild monthly swings on the back of, whether inflation's on again or off again. Now, it seems in the last sort of 3 or 4 months that the situation has stabilised. Inflation has come down and the economy has in America and Australia has not completely cratered. And there's a sense that interest rate cuts could come through. We're still pretty wary of that sort of drawing a very firm conclusion. But the way the relevance to us is what does it mean to the cash flows of businesses? We still think there is a lingering risk of, and we're not forecasting this with any firm numbers, but we think it is definitely a risk that inflation, particularly with wages catching up, still catches out the odd company that is it does not have pricing power. And equally, the expectation that the world would go from such a disruptive position on inflation and interest rates for the first time in 40 years back to completely normal very quickly is potentially a bit bold. So we still think it's potentially over the next 12 months a source of volatility.
And I'm pretty sure I know the answer to this question, but given some of the themes that you've highlighted, is now a good time to invest in small companies?
We believe it is. Yeah, the last 2 years have been pretty challenging, frankly. The small companies have underperformed the broader market by 20% over a 2-year period. And if I think back over the 20 years since we've been running this fund, that's as almost as bad as it was during the GFC and COVID. And in 2013, there was a big downturn in small companies in a relative sense compared to the large caps. Now, what typically happens is that that level of drama, if you like, that drives small companies to underperform so much is typically driven by major macro events, which distract everyone and brings everyone's attention span to the very short term rather than stock picking. And it creates enormous volatility in the actual stock prices of the companies that we look at. Now, it's painful at the time and things are flying around in every direction, but when there's a sense of calm, and we don't know exactly when that'll start, but it will at some point, when there's a sense of calm, the companies that were always grinding away, predictable cash flows, those sorts of things, but their share prices might have been sold down for more macro reasons, they typically open up very strong opportunities for performance. Now, a fund like ours often has to be patient and sit on investments for longer than we thought we would. But typically when it turns very quickly. No one's going to call you the week before, and we know that. But certainly our strongest periods have definitely been coming out of the GFC, 2013, and coming out of COVID. And that's because stock picking returned to normal. And we think the settings are in place. We just don't. We're not waiting for someone to ring a bell. We're ready. We're invested, and we think all the settings, as I mentioned, are certainly. There's a certain amount of rhyming from prior experience where we've performed quite strongly.
And Ed, the fund is approaching its 20th year this year. Has anything changed in terms of philosophy or process over this time?
As boring as it sounds, Lana, no, it hasn't. There's only two of us that we've run the fund since day one. We set it up with a very strict sort of philosophy around investing, active visitation of companies, making sure we know the management very well, and we're always busy looking at new businesses and new companies to potentially invest in. We don't get carried away with wild valuations and things like that. We don't invest in things we don't understand, and there's been no turnover in staff at all. So it changes every day because the market does, but the people and our approach hasn't changed at all in that period.
Thank you, Ed. That was incredibly insightful. And thank you so much for joining us today. As Ed mentioned, the fund is approaching its 20th year. Over that time, we've maintained consistent performance of 12% per annum net of fees, which is an outperformance of over 7% over the benchmark net as well. I sit in the office with Ed and Steve, and I can honestly say they truly are the two most hardworking people I have had the pleasure of meeting. They take their fiduciary responsibility incredibly seriously, and they are a safe set of hands for your clients' money. The fund is available on all major platforms and is extremely well rated by research houses. If you'd like to know more, you can subscribe to the newsletter via our website, or please feel free to reach out to your local BDM. We'd love to hear from you. Thank you.